Good morning, everyone. Thank you very much, Claire, for the introduction. We're going to talk about the non-bank financial intermediaries. It's becoming more relevant in terms of the funding of the economy, but simultaneously, it has attracted a lot of attention because of the potential risks for financial stability and the question of the interconnection with the traditional banks. No? Under this category, we find a space that covers many different animals. I will not use the quote of George Orwell, but there are quite different animals in terms of their characteristics and in terms of the supervision and regulation. To analyze and much more in detail this topic, we have your paper and presentation by Loriana Pelizzon, professor of the Goethe University and at Foscari University of Venice. Welcome. Loriana's paper will be discussed by Nicola Cetorelli from the New York Fed. So, you know the housekeeping rules, 20 minutes for your presentation, 10 minutes for your remarks. And so, without further ado, please, Good. Loriana, take the floor.
So thank you very much for inviting me to present this work. It's a joint work with Riccardo Mattiello that is also here. He's a PhD student at Foscari University of Venice and Warwick, and Jonas Legel from the Leibniz Institute SAFE. I'm very happy that, thanks to this opportunity, I went back to work on a topic that I worked quite a lot 10 years ago, or more, 15 years ago, on non-bank financial intermediaries, mostly on US data. This time, I try to use mostly European data. And as you can see from the title, what we are trying to investigate in this paper is the growth of the non-bank financial institutions and their implication to financial stability and monetary policy. We are asking 4 different questions, quite challenging, as you can see. The first, how large is the financial system in the euro area, and how does it compare with the US? The second one is, how much are the euro area non-bank financial institutions supporting the real economy? And then how they are going to reshape financial stability and monetary policy transmission in Europe. And under this question, I also try to address another important topic that it has been debated quite a lot, that is, should non-bank financial intermediaries access or not on the central bank balance sheet? And the question is, should they access or not? Should they access on the liability side, on the asset side? And I will have just a few things to say about this. And then finally, we are going to investigate how could the non-bank financial institution in Europe help or benefit also from the capital market union or the savings and investment union. I'm starting with this graph that is representing the total financial system in Europe according to ECB data. And you see on the y-axis, there is these percentages that indicate pretty much how much the total asset that you are going to sum up for all the different financial institutions that you have in Europe look with respect to the GDP in Europe. And as you can see, banks that are the light blue represent about 2 times the GDP, with an increase till 2008 and then a significant reduction, but quite stable around 2 times. Then you have clearly the intervention of the euro system, but then in green you have insurance company, in blue you have investments, and then in orange you have these other or remaining other financial institutions that all together, as you can see, has been grown together with the banks till 2008, and then later on continue to grow even if the banking sector in some sense is going to, with respect to the GDP, reduce, and reaching a peak of 8 times the GDP in 2022, and now we are around 7 times the GDP. So clearly, already looking to this picture that clearly is just, the sum of a lot of total assets that can be intra-group or, let's say, intermediation, it is quite interesting. So it's telling us that really the financial system in Europe looks quite large. If we are comparing it with the US financial system. And in this case, I'm using data from the 1980, but after the shadow part is exactly from 2000. You see that in terms of GDP, there was this growth till pretty much again 2008. And then after 2008, it remained quite constant, 5 times the GDP. Banks are still in light blue, representing just 1 time the GDP in the US, and the rest, is significantly important pension funds, so the composition is also different with respect to the one of Europe, insurance, money market funds, and so on. So clearly, these 2 pictures are telling us quite important things, that in both cases, the financial system is very large, and that non-bank financial institutions do play a significant role in both these systems. If we're focusing on the non-bank financial institution and just look to the pattern, the numbers are telling us that in 2000, there was a significant difference of the non-bank financial institution between the US and the Euro area. But then, as you can see, they look quite similar. So after 2014, pretty much the 2 percentages in terms of GDP are quite similar. And the question is, how can we have all this, let's say, significant amount of total asset that represent all these non-bank financial institutions? And the first question we are asking is, where are they investing? What are these non-bank financial institutions, helping maybe the real economy? And this is the graph, now is in trillion, so I'm just giving to you not in terms of percentage of the GDP. For Europe, as you can see, non-bank financial institutions are also interacting a lot among each other. So for example, insurances are investing on investment funds. So clearly, these total assets are summing up in this way. Then there is a significant also interaction with the banking sector, and there will be then Nicola going to stress maybe this aspect more. And then we have that the amount that is devoted to lending, for example, to non-financial corporates is the light green, that is not so large. There is also not too much investment, or at least, is a fraction also investment in government. If you are asking the same question for the US non-bank financial institution, the picture is quite different, and is this one. So again, you have a lot of interaction between non-bank financial institutions, but they are also lending a lot to the householders. They are lending a lot, look to the green part, to the non-financial corporates, and the part that it is in gray, that is the rest of the world, is quite small. Instead, if we go back to Europe, you see the significant fraction of the European non-bank financial institutions are, in most of the case, investing their money abroad. And when I'm saying abroad, the significant fraction is the US. So already these graphs are posing more questions than the answer that I'm able to give to you. And I'm trying to provide some potential reason of why we are observing this type of pattern. So why do we have that the financial system in Europe is so large, but is investing so much abroad? And, I just provide several reasons. The first one is that when we look to the GDP and we see that they are looking quite similar, it's not that in trillion they are similar, because we are talking about 50 trillion versus let's say 100 trillion or 80 trillion. But the fact is that the denominator is quite different. We have lower GDP growth in the last period in Europe with respect to the US, and this is, producing this effect that the non-bank financial sector is 3.8 times the GDP in Europe compared to 3.3 times in the US. Another reason is that the financial system in Europe is having a lower access to the capital market, and also we have a longer intermediation chains that clearly is going to pile up the total asset. Because one thing is that you get direct access to the capital market, or there is a lot of intermediation that by creating this chain, of course, it can be efficient in the way in which the resources are allocated, but on the other side, maybe if there is some problem in one of these elements of the chain, you can have some spillover effect. Then it is very high also because, the non-bank financial institution in Europe has to allocate a lot of saving. In Europe, we are saving more than in the US, so there is a lot of investment that need to be done. And then there is also that these savings are largely managed by global asset managers in Europe as well. And we don't have the big champions, as we don't have champions for banks. We don't have champions for the non-bank financial institution. And like, for example, BlackRock. And then the other thing is that there is already this huge debate, so it's not that I'm the first one going to point to this, but we have the capital market that is underdeveloped, is fragmented, is segmented, including also the sovereign bond market. There was already some debate about this yesterday. And I'm sure that if I'm going to talk with any of you, you will have a lot of other reasons. So I'm not going to debate which one it is the most important and so on. But the focus that I want to point is that clearly the non-bank financial institutions are an opportunity. It's true, they can be very risky, but we need to consider them also as an opportunity to develop the capital market. And so far, they are a missed opportunity because most of this funding, for diversification reason, because the stock market in the US is more developed and so on, are largely invested abroad. But, and this means that clearly we need to try to think better on how we can, exploit these opportunities. And clearly having a better saving and investment union not only will help all the economy and so on, but will help also non-bank financial institution capital to be invested, at least in a fraction, in Europe. And another thing is not only that the non-bank financial institution will benefit by having a very nice, large, developed capital market in Europe, but they can help to develop the saving and investment union. Because there is one characteristic that is going also to explain why yesterday REFET were telling us that the corporate bond market is far integrated in Europe. Because the non-bank financial institutions in Europe, they do not face cross barriers as banks are facing. And to show this, I'm showing to you this graph that looks quite complicated, but is very simple, and is coming from one of my former PhD students that is now at the ECB. And what they did using the fantastic database that they have, they were looking how much the investment funds in Europe are collecting money. So on the left-hand side, you see the investor countries. And with the different colors, you have all the money. Where are these money going? So the country incorporation of the funds, not surprising, are largely Luxembourg and Ireland, but also the other. But then the money are, again, reinvested quite a lot in a diversified way in all the different countries in Europe. We don't see a significant home bias, as we are usually thinking about investment funds, apart from the fact that a significant fraction, of course, is going abroad. So clearly, this means that the non-bank financial institutions in Europe do not face the classical border, let's say, limitation that the banking sector is facing. So how can we try to use better this possibility? And the usual thing is that we need to enhance the capital market infrastructure. So if we want that they are also helping credit in Europe, we need that to have maybe more covered bonds or asset-backed securities where they can invest. On the other side, maybe we should think to have a better market in terms of private credit and private equity. I know that there is a lot of debate on it is good or it is bad, but the fact is that so far, the European non-bank financial institutions are investing in private credit and private equity in the US. And we don't have data. We have no capacity to figure out what are the risks that, in terms of maybe the benefit, that we are facing on this other part. So clearly, I think that if we want to debate and figure out what are really the source of risk, and now I'm starting to talk about risk of the non-bank financial institution, the first thing is that we need to understand better what they are doing abroad. because as you can see, a significant fraction of this total asset is invested abroad, with implication for systemic risk, but also implication for monetary policy. And I'm going to talk about this later on. In the paper, I don't have the time, but in the paper, I investigate the 5 traditional indicators for systemic risk, that is size, and clearly, they are not individually very big, but if you are putting all together, and the fact that they are interconnected in a chain, they are big, and they are highly interconnected. And as I said, I'm leaving again to Nicola the space to discuss about this. I investigated also the 6 other specific indicators that the Financial Stability Board and the IOSCO indicate as relevant for non-bank financial institutions, and I can mark that the most one is risk concentration and links to core financial institutions. But then we need to remember that the European one, in terms of systemic risk, face 3 other challenges. One is opacity and data gaps. Because if you want to investigate if they are facing some risk, you need to have the data to try to figure out where is the risk, what is the exposure, and so on. And then we have other 2. One is the inadequate supervisory coordination and fragmentation. And on this is the pretty much where is the country where these non-bank financial institutions are located. And the orange is Luxembourg. And then you have Ireland and Netherlands. So clearly, we have a concentration in some countries of all this funding collected across all Europe, and we don't have yet in Europe a unified supervisory mechanism. So again, if we want to supervise systemic risk, we need to have a unified, let's say, way to look to all these different entities. And then the third one is that after several events, starting from the US in September 2019, then we have March 2020 and so on, we know that if there is some turmoil in the market, central banks are intervening. And this clearly is creating an expectation to the financial system in general, not only to banks, that there will be a backstop. This is clearly, inducing mostly non-bank financial institutions to engage in excessive risk-taking, under the assumption that there will be some rescue. And this has been already discussed in the paper by Czeslak and Annette regarding the Fed put. But then there is this beautiful document produced by the ESRB Advisory Scientific Committee about the market maker of last resort. And we need really to figure out that central banks now do have, in some sense, the capacity eventually, to intervene under also this other head. This is moving me in the last 3 minutes on the role that they have for monetary policy. And, in the paper, we are discussing about the different channels. You can call them in different ways. I'm sure that we can discuss a lot, but I focus on one of them, that is the interest rate channel. So the capacity that the central bank are having to control the short-term rates, and that will have an impact on the rest of the term structure. And there is already ample evidence that non-bank financial institutions are providing a significant footprint, not only in Europe, but all over the world. And based on this, I'm also talking about central bank access, giving access to their balance sheet to non-bank financial institutions. So the way in which I'm going to investigate this question is by looking to this dispersion index that is measuring the dispersion of the rates in both the uncollateralized and collateralized general collateral and special collateral repo market for Europe and for the US. I want to thank, in this case, Iman and also Benoit that give to me this data. And as you can see, in Europe, it's not that the central bank is not able to control this interest rate. The dispersion is not so large, but is a little bit different than the one that you have in the US. And according to Duffy and Krishnamurti, this is due to the fact also that the non-bank financial institutions do not have access to the central bank balance sheet. The reason is that in Europe, we do have a lot of other problems regarding this. And the first is that if you're looking to the repo market, the special collateral, we have scarcity, that now is reduced thanks to the increase of the interest rate, we have scarcity of the different collateral. So this graph is showing to you that with respect to the deposit rate facilities, you can borrow at a far lower rate if you are giving as collateral one single specific German bond. But you get the same also if you're using an Italian bond. So it means that really the use of collateral, sovereign collateral in Europe is allowing you to get a rate that is lower than the deposit facility rate. And it's not just, one rate. It's a lot of rate. This graph, again, is coming from a paper of Benoît Noyen, Davide Tomio, and Andrea Poinelli that, is showing to you that this dispersion depends a lot on when you are transacting and with whom and so on. So clearly, there is a lot of dispersion on top of the fact that there are fragmentation, market power, and so on. But the question is then, what can we do? If we want to keep everything in the corridor, is there any chance that maybe we should give access to non-bank financial institutions to the central bank balance sheet? And in order to investigate this question, we look first to the facilities that are in place. One is the overnight reverse repo facilities that is in place since 2014 in the US, but it has been heavily used after 2021. The contingent non-bank repo facility by the Bank of England, never used. And then we are asking, but I don't have too much time, are these two facilities helping to reduce let's say, the dispersion we have in Europe? And the answer is no. You need something else. You need the security lending facility. What it is that the bond that the central bank is holding is given as collateral in exchange of cash to the system. In this way, you will have the possibility to put a cap to the, or matter a floor to the short-term rates. And therefore, the on-RRP for Europe is not helping us to reduce this dispersion, but only the possibility to have collateral scarcity reduced, or if we want to put a cap on the corridor, then maybe we can think to what the Bank of England has suggested. So the suggestion is for collateral scarcity, extend the security lending facility to a lower basis point from 20 basis points now to 5 basis points as the US, and maybe to some other entities. And for stress episodes, start to think to have a dedicated contingent non-bank financial institution repo facilities, of course not to everyone, but to key non-bank financial institution participants under an appropriate regulation. And this will help us to have also better data about this non-bank financial institution. To conclude, we need to develop the saving and investment, also to channel all the money that we have invested now in non-bank financial institution. We should have a better covered bond market, maybe having the same structure as the European data warehouse is doing for securitization. Strengthen the supervisory framework under a supervisory mechanism. And then, if we consider important to maintain everything under the corridor, expand the security lending facility and the contingent non-bank financial institution repo facilities to key non-bank financial institution participants under the appropriate regulation. Thank you very much for your attention.
Nicola, please, go ahead.
All right, thank you, Luis, and thank you for including me in this event. Right, let me start with the usual reminder that what I'm about to say represents just my own views and not necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System. All right, let me jump right in with a very curated summary of the paper. This is a very rich analysis that Loriana and co-authors put together in, I think, in a very short amount of time. Congratulations on that. So it's a curated summary because I'm going to just pick and choose liberally on specific aspects of their analysis, on things that resonated with me and my own understanding of NBFI evolution and things that I want to base my remark on. So on the growth of NBFIs, we learned that, yes, there is a commonality in overall trends between Europe and the United States, but there are also important differences. There are structural differences. The euro area is much more bank-centric, historically so. This has a lot of implications, many of which Loriana talked about. There is one point that I wanted to mention that she only alluded to very briefly in her remarks, but in the paper is mentioned. The fact that, in fact, because of this bank-centric structure in Europe, in fact, there is a significant footprint of non-bank financial institutions inside banking firms. And this is something that I'm going to talk about toward the end of my remarks. On financial stability, I'm not going to say much here. These are well understood trade-offs. I'm just going to leave the bullet points here. Again, structural challenges in the euro area, I think, is the important thing to take away from Loriana's remarks. The monetary policy, I want to spend a few seconds on this. I thought it was very intriguing, the point that they make that we could use NBFIs as a potential vehicle to overcome some of these challenges in the euro area. That's absolutely interesting. And I'm stressing here, highlighting this point, and I put it as a with a question mark. Should we allow non-bank financial intermediaries to have access to central bank liquidity? Is that a necessary step? So now my remarks. So what I thought it would be actually useful for the consumption of this audience is to add even something extra to the already rich analysis that Loriana and co-authors put together. But what I hope I will achieve is to take a step back and, while this is an incredibly complex, very heterogeneous set of institutions, Luis was alluding to this very big group of animals, maybe it could be useful to take a step back and simplify, go back to very, very simple questions related to NBFIs, and really, ask why do we actually even observe the emergence of non-bank financial intermediaries, and how is that growth sustained, right? So these are very, very basic questions, and I promise you these are not trivial questions to pose. Hopefully, I'll convince you in a slide or two. And my goal, my hope is that if we can identify some common principles, some basic economic forces that can explain those questions, then we may be able to actually develop some sort of a coherent and, in fact, jurisdiction-neutral view perspective to interpret the evolution that we have been observing both in Europe and the United States. So I'm going to offer just one principle for this discussion, and it is summarized in the title of this slide. NBFIs are naturally dependent on banks. So if there is one thing that I hope you will take away from these few minutes of discussion is this point, okay? So let me try to spell it out. So we are talking about institutions that are not banks and engage in intermediation activities. That means that are engaging in maturity and liquidity transformation. And we know that a necessary element of the business model of an intermediary is to manage liquidity risk. Okay, that's the essential component of the business model. And we know that intermediation is intrinsically fragile, intrinsically unstable. How do we know that? Well, we can look at banks, traditional intermediaries. How do banks manage liquidity risk? They have access to stable funding sources. We have 150-year give and take of modern banking history to try to answer this question, right? So they have access to stable funding, but I would say that in large part that stability is the result of the granting of collective guarantees, right, behind those funding sources. And that's actually not even sufficient, right? We have learned the need to actually also give privileged access to these intermediaries to lender of last resort facilities, right? Very, very basic points that I'm making here. So now we have non-bank financial intermediaries that do not have, at least on an ex-ante basis, access to liability guarantees. They don't have access to liquidity facilities. So now you understand why I think it's a fundamental question that what I was asking before. How can they be successful? How can we observe this growth absent this very necessary ingredient for their stability? So maybe society have been able to engineer some new form of intermediation activity that I'm not aware of. And I think it's actually much simpler than that. They can buy these services, and who can actually provide those services? Banks. That's what banks have done from the beginning of times. Right? Very, very simple point that I'm trying to make here. But I think that the implications are quite profound. So that's a conjecture that myself and my co-authors have actually sort of entertained for a number of years, and then finally we have been able to bring it to the data. And I think that there is strong evidence that there is this intimate interconnection between banks and non-bank financial institutions. This is looking at data from the United States. There has been a massive increase in this liquidity support from banks to every stripe and color, really, of NBFI types, okay? And again, yes, I'm looking under the lamppost. I have access, privileged access, really, to data from the United States. But this point, this evidence is actually mounting. You may have seen a lot of references in the news, but also other economists that increasingly are stressing this point. And there is also evidence that, you can see here in Europe as well. So we can use this principle to now go back to these fundamental trends that we have observed, that Loriana and co-authors have analyzed. On growth, I would just make a very simple point that perhaps asset growth per se does not tell the full story, right? If you're willing to concede the fact that, at least in part, that growth is supported by banks, right? So it's not really a story of substitution of NBFIs growing and banks somehow losing ground. It's more a story of banks transforming their role. I'm not going to say that, but you could say that it looks like the banks are somewhat moving in the shadow of intermediation activity. And so you can perhaps even draw in a hypothetical counterfactual, which is that absent this bank support, perhaps we would not be observing this significant growth of NBFIs. Financial stability implication, again, I'll go very quick here, just putting the bullet points. The obvious implication is that it's even more complex, no? That there are even more channels of risk propagation and amplification, and banks themselves actually can be a vector of instability because of their intimate connection to NBFIs. I want to close with a couple of slides on monetary policy considerations to go back to this fundamental question. This is the elephant in the room on any NBFI discussion nowadays, right? Should they be granted access to central bank liquidity? And I think, again, the standard trade-offs are well understood, and Loriana and co-authors do a fantastic job in covering all the bases. Eventually, it's a trade-off, and hopefully we could do this to achieve these goals for monetary policy, trying to minimize the moral hazard, right? But let's assume that you can do that. And I'm going to venture that actually that may not be a stable equilibrium, right? Why am I saying that? Go back to my principle, the one that I was stressing a second ago. Giving access to NBFI, to central bank liquidity, effectively is going to sever that connection with banks, that dependence on banks. And you could say, well, maybe that's a good thing, right? Maybe. But the implication of that, you may actually reduce what has been really the uniqueness and the specialness of banking institution. And I would venture in suggesting that maybe that would do it for banks, right? You would actually now observe the debasement of banking institutions. But that too may not be the end of the story. Why? Because presumably banks are not going to sit idle observing this process. And I can imagine that they would actually mount some strong lobbying to, invoking leveling the playing field. Now, all of a sudden, you have these fierce competitors that would have access to the same privilege, lender of last resort, one way or another, but they're not subject to the same strict prudential standards, right? So my point is that we may be observing an equilibrium, which is kind of a race to the regulatory bottom, that maybe that's what we want collectively, but let's analyze all the possible implications. My final point, I'm out of time, maybe there is an alternative approach, and I go back to the original point. If it is true that there is actually an important component of NBFIs inside banking group in Europe, maybe we can leverage this model that is prevalent in the euro area. And we could provide the conditions for the growth of NBFIs inside the banking groups. Why would that be? Because maybe we could achieve the best of the both worlds. I'm very optimistic here and provocative, and we could debate that. On the one hand, we could have the growth of these specialists that might be able to support the capital market development and the reduction of the market segmentation, et cetera. But then all these intermediaries would be subject to homogeneous prudential standard by virtue of being inside the banks. And so these liquidity needs, this fundamental point that I was making, would be internalized within the conglomerate, and that would be possibly a positive thing. By the way, this was the prevalent model of operation in the United States for decades, up to the global financial crisis. There was a very significant non-bank footprint inside bank holding companies. And it is the case that actually intermediaries inside US bank holding companies were less reliant on central bank liquidity in times of stress because they could use these internal synergies. I conclude. I was just a word of caution. This is not, I'm not suggesting that banks are at the center of the universe. It's actually the opposite, right? I'm recognizing that the system is so much more complex, but we need to absolutely put front and center the fact that there is unavoidably a symbiotic relationship between these different types of institutions, and this is not an accident. It's not the bug of the system. It's actually a structural feature. And if we focus on that, maybe we could develop also the right insights. Thank you.
Thank you very much, Nicola. Loriana, I don't know whether you want to react briefly.
No. I perfectly share the presentation. Yes.
Presentations are very
Yes.
I have a question for both of you. Is because, well, one of the issues that you have raised is the possibility of having access to central bank money. But don't you think that before that we should have a sort of macroprudential toolkit? Well, non-banks is a very mixed bag. You have from pension funds to hedge funds, going through private credit, private equity, and these kind of things. But now perhaps the discussion about the access to the central bank money is much more focused on money market funds. But here, we can see that the regulation, the lack of a real macroprudential toolkit for money market funds and mutual funds is not an obstacle, or perhaps we should have something before.
Of course,
that.
So thank you very much for the question. I think that there are a few things that we need to consider. First of all, as you said, and it's not that simply you give access to any type of institution. They are quite different. And I think we need to understand better what they are doing before to decide also, we want to regulate in one way or in the other. Regarding the money market funds, in the US, they have access to the liability side of the central bank. So pretty much they can deposit, but differently than banks, they deposit and they get collateral as in exchange. So it is different than the reserve of a bank. First. Second, it is done only for money market funds that are investing in government bonds, short-term term maturity government bonds. So before, in the US, they did this regulation to create this type of money market funds, and only to these money market funds they give access to the liabilities, in this case, of the central bank. The question is, in Europe, do we need this? So in Europe, the money market funds are very tiny, first. They are not investing too much in government bonds. They are investing a lot abroad. I didn't have time, but it is well described in the paper. So clearly, the money market funds that we have so far are not the ones that are getting access now in the US. But they are already posing a significant challenge to the banking sector already in the US. Because when the Fed really changed the interest rate at which they were going to remunerate this cash deposited by the money market funds, what you can immediately see is that a huge increase of the deposit at the money market funds and a reduction of deposit at banks. That has been then created the run that we know with SVB and so on. So clearly, in the banking sector in Europe that is very bank-centered, creating all this competition will, I think, create more problems than the one that they solve. This is why I think that we need to have and to think carefully to the facility that will help the transmission of monetary policy as it is in Europe. We cannot just copy the US because in the US they are doing this.
Thank you very much. And Nicola, one question for you. I think that is very interesting, what you have commented about the interconnection between banks and non-banks. But there is, I think that my impression is that the segment of the non-banks that is growing, more quickly is private credit, yeah, and private equity. What's your view about this phenomenon?
It's the poster child of what I was describing, actually. And I'm glad that you are bringing that up. Because it's really hard to talk about MBFIs in general because it's an undefined set, right? So let's focus maybe on specific segments. And private credit, on the surface, if you look at it, it looks like it is a model of intermediation that is fundamentally based on equity funding, right? They have very, very minimum leverage. In fact, in the United States, business development companies at least have very strict leverage restrictions. So that's true. But then they make loans, right? So they are exposed to exactly the same kind of risk that I was describing in my discussion. So if you look at it, it looks like maybe, yeah, we have engineered something new that allows them to be intermediaries somehow without performing liquidity transformation. Well, if you look actually more closely, they are extremely reliant on banks for their business. So they need a lot of liquidity. So they rely on credit lines for their business. And the fundamental reason for it is that exactly because their activity is based on equity and capital calls from their investors. It's very hard to manage capital calls. Even if you're an investor in a private credit fund, the fact that this fund actually has subscription lines of credit that the fund can use to manage temporary liquidity needs is actually giving these investors an extra incentive to put the money in these funds. So yeah, actually, it's that same story.
One question, about private equity. Perhaps they are not extremely leveraged, but if you look at the companies that they invest,
yeah,
these companies are extremely leveraged normally. Yeah?
Oh yeah.
So leverage is something that we need perhaps a holistic approach with respect.
No, exactly, and that's the point that I'm making. Now, so they are taking a lot of risk because their clients are clients that are going to need themselves a lot of liquidity needs, and so these providers of credit, the private credit firms, will have to satisfy those needs. And again, banks' support is actually fundamental for them.
Thank you very much. Now we open, we will start here by the center. I see Vito, please to the point, Vito, and concise if possible.
Vito Constancio, former ECB Vice President. Thank you very much for the paper, which is very rich in information, and also for the discussion by Nicola. Very useful. I have a comment and a quick question. The comment, which also contains an implicit question, is that you highlight, and it's absolutely factual, that these non-bank financial institutions invest a lot outside Europe picking savings in Europe and then investing outside. What you treat academically as a fact in policy papers from the Commission and reports and so on is portrayed as a complaint that Europeans save a lot and then a lot of those savings are invested abroad. But the causes for that are not just microeconomic causes, as you mentioned. It's also the result of the macroeconomic regime that we have that generates a current account surplus around 3% of GDP, which by definition means that we are exporters of capital to the tune of 450 billion a year. And so someone must be the vehicle of those exports of capital. So what do you think about that macroeconomic perspective on that point? The question is about securitization. It's in one of your recommendations, and it's also a big point in the Compass Commission program, the securitization. But it's not happening, securitization. So my question is, what should be done to change that? Because there is an issue there. In the past, the banks had a self-interest in doing securitization because they would save capital and all of that. Now they have capital well above the minimum regulatory level, so they don't need to securitize for that reason. And also the transformation ratio of banks is now much lower than it was, so they don't have, apparently, they don't see many alternatives to then expand the balance sheet or other things if they get rid of some assets that they have in their portfolio. So do you really believe that securitization could really be jump-started, and what would be the recipe to achieve that? Thank you.
Thank you very much, Vito, Xavi, and Joaquin. Xavi.
Thank you for the nice presentations. I have two questions. The first is that, is the classification of the non-bank financial institutions useful? I think there are too many different animals inside. And so maybe we should advance to the next step to differentiate them. So from the money market fund to the private equity to the pension fund, there are very different regulatory regimes behind. So I don't know. I question a little bit the generalization, and so I don't know. Want to know what you think about that. And the second is on the Nicola's alternative approach for Europe. I understand your idea for the US. But for Europe, for a system which is bank-dominated, and where banks put barrier after barrier to the entry of market-oriented, mutual funds, which are much cheaper sometimes than the services of the banks, etc. So I think it may backfire because it could reinforce the dominant position of banks in Europe, and in fact do not bode well for the capital market unions and for the progress towards more also market-oriented finance in Europe.
And finally, Joaquin.
Yeah, thank you very much to both of you. Very interesting. If it looks like a duck, swims like a duck, and quacks like a duck, it's probably a duck. So what I would like to say with this, that many NBFIs, they act like a bank. And I have a very clear view about this. The consequence should be that we regulate them like a bank. And we are lagging behind here. All, let me say, other consideration, trying to find an interim way, at the end, I believe they will not be very helpful. We should regulate them much more strict, much more robust, because you alluded to that in your presentation. All the things they are doing, they have so many similarities to a bank, and they have this interconnectiveness to the banking sector because of the liquidity lines. So we have to do much more on this. This is my clear view here. Thank you very much.
Thank you very much, Joachim. Now, Loriana.
Yeah, so thank you very much for the different points. Of course, yes, regarding the fact that, if we are indeed a lot of savings and in the international. So, but the question is, why are we doing it via this non-bank financial institution? It can be done in another way. Is it efficient? So clearly, this is another paper that will be nice to write. In fact, after all this analysis that I have done, I have already a plan of several papers. So it's not that this is the end. Actually, it is just the beginning. Regarding securitization, I do see that securitization can be done only via banks because they have now the access to the small and medium enterprise. We can start, in any case, I don't have all the data, but there is signals that, for example, covered bonds now has been done not only in Germany, but also in other countries. So this is why I was pointing more to this rather than the classical securitization. On the other side, we have a lot of credit, let's say consumer credit, that is growing. And the question is, what is going on? We have all these consume today and pay tomorrow. All this part that is maybe done via this securitization, we need to figure out better what is going on. So there is space for this. I don't know if it is good or bad having this in Europe. But on the other side, so either the firm in Europe do not need more credit than the one provided by the banks. So this is the key question. Or if they need, we need to find a way that banks are intermediating this, but this firm will get credit in some other way. Regarding the, well, I think that Javier is mostly asking to Nicola, so I'm leaving this to him. Well, they are indeed doing the same things as banks. Should we regulate them? Well, maybe the answer is yes, but the problem is that, if you're looking to what is going on in the rest of the world, they are growing, they are making a lot of profits, and a lot of funding in Europe are going to the same institution abroad. So the question is, what is the smart, let's say, response that Europe has to give in this case? Because we can continue to regulate everything, but the risk will be abroad, and we are investing abroad and taking, in any case, all the risk. So I think we need to go more deep on why we are investing all this money abroad, and where are this money going, and what are the benefits for Europe.
Nicola.
Yes. No, I want to start with Joachim point first. It's funny you mentioned the ducks. I used that once, that metaphor in a presentation, and it put me in a lot of trouble. So I'm glad that you are doing it. Yeah. And yes, I think you are touching exactly on the fundamental point. If it is a bank-related activity, I think we need to have an honest adult conversation about that. So I would totally agree with that. Xavier's point, yes, it's an incredibly heterogeneous set of institutions. And so maybe the institution angle is not the right way to approach it. Maybe focusing on the functions, the activity might be so much more relevant, and it would maybe also take us, eventually to the same point that we are discussing, right? On the European exception to what I was describing about, the financial conglomerate model, I think at the end of the day, you may be right, and obviously, I take advantage of my role as discussant to just put stuff out there. You don't have to believe it, but no, seriously. So one of the reasons why Europe seems to have this, fundamental structural challenges with banks, also being so severely home biased, I think it goes beyond the nature of the banking business per se. I think that there are frictions in the European Union that somehow foster this segmentation. One of such frictions, I think, is the fact that there has never been a completion of the union, right? So there is a fiscal element that is missing, and I think it's going to have implication for market segmentation and also for the way how financial institutions operate. And so, in a way, I guess these challenges are bigger than just related to the financial institutions at play. If I look at the history of the United States, in a way, United States used to be a highly balkanized system, right? The banking system, the United States used to have effectively 50 separate, banking markets, right? And so the process that led to, also much higher level of integration of markets went as a result of that, that deregulation at the state level that facilitated, movement of capitals across states and et cetera, the developments that I was mentioning about. So there are some necessary steps to be taken, to Luis' point before you actually approach, things that are related to institutions.
Thank you very much. We have only 2 minutes left, but I see Richard and Olli Rehn and Pierre Gouge. So we close, please.
Congratulations to Loriana on a very comprehensive paper. There are so many issues here. We deal with a lot of them, of course, in the European Systemic Risk Board. And we publish every year the Non-Bank Financial Intermediation Risk Monitor, which covers a lot of these issues. So I will pick out only one, and that is supervise them like banks. Yes, but these institutions operate transnationally. They are supervised by the national competent authorities, not by ESMA. Mm-hmm. And how could you, and I think this is the question that I would put coming out of this, how could you give non-bank financial intermediaries access to the ECB balance sheet without effective European Union level supervision? I just can't see that.
Thank you very much, Richard. Olli, please.
Thank you, and thanks to Loriana and Nicola for very insightful presentation and discussion. I particularly welcome your emphasis on the positive role that the non-bank spectrum can play to enhance capital markets in Europe and the savings and investment union, without forgetting the financial stability considerations. My question relates to a driver of financial system today, that is stable coins. And we are on as Richard actually has been working on this, for instance, on the European Systemic Risk Board, we have been quite concerned about and closely monitoring the development and integration of mainstreaming of stable coins to the US financial markets. What kind of systemic risks do you see, you assess this could cause to the financial system of the euro area, and what kind of reforms or policy measures you consider most urgent to tackle this, so that we ensure that they don't undermine financial stability or monetary sovereignty?
Thank you, Olli. And finally, Pierre.
Thank you. One remark and one question. The remark is on securitization. What the banks told me in Belgium, at least for mortgages, is that their margins are too low, so they would not be able to sell that to the market. And the margins are low because they use it to attract customers to get cheap deposits. I don't know if it extends to other countries, but it might be part of the explanation for why you don't see this growth in securitization. My question is actually sharing my confusion, because we've had two papers, one yesterday, one today, that actually tend to show that the markets are, despite a lot of impediments and fragmentation, working quite well in Europe. So I'm wondering how big is actually the problem of lack of savings and investment union. And as much as there are different kinds of NBFIs, maybe there are different kinds of issues with the savings and investment union, and we should be more disciplined in having those discussions separately, because otherwise we discuss something that is so broad that actually we are not discussing anything. But it looks like it's not so bad, actually.
Thank you, Pierre. Loriana.
See, so thank you very much. Well, regarding Richard, of course, I share perfectly the fact that, before to talk about giving access to central bank, we need to have information and a good supervision. So I subscribe the fact that the fragmentation we have so far in Europe about supervision is something we need absolutely to change, and the fact that mostly for non-bank financial institutions, at least we start to share information. Because at the country level, there is still this problem. But these non-bank financial institutions are growing, are large, are operating, as I say, transnationally, as you stress, but we have difficulties not only to supervise, but to monitor what is going on. Regarding stablecoin, I think we need to do just a meeting only for this, because at the advisory scientific committee at the ESRB, we are now working. We have a task force. I'm working on this, and I can spend hours. But the only thing is that if you read in the document that I produce, in the mapping that I have about the financial system, there is also the stable coin. So they are exactly in the money market framework. So, they are really going to create maybe a lot of problem in controlling eventually the short-term rate. So this is the only thing that I'm going to add. And, are we so bad about the capital market? Well, maybe not, but, clearly there is a lot of other things that can be done. And I perfectly subscribe the idea that we need to talk about the individual one. But, it has been asked to me to talk about non-bank financial institution. In general, if I will focus only on one, then people will start to tell me, yeah, but what about insurance? What about this? But it's true that we need to go to the micro level and distinguish them. But having also a big picture is also helping, because they are also interrelated one with the other. And having an idea of how large they are, for me, this work of looking to the aggregate data, it was very useful.
Nicola, 1 minute, please.
No, I just want to make a general statement. I don't think I want to answer to the specific of the question, but maybe in a way touching on the very last comment that maybe I was sort of portraying a sort of a negative picture of this evolution, and I want to make clear that that's not the case. There are a lot of positives associated with these developments. And again, this set of institutions foster capital markets, and they definitely, most of the times, they're going to be net positives for society of having, this type of developments. But at the end of the day, we're talking about intermediation activity, and again, we should be drawing also, our inference from the past, history. Yeah.
Thank you very much, Nicola. Well, I will finalize quoting George Orwell in Animal Farms, that because we have talked about ducks, about elephants, all the animals are equal, but some animals are more equal than others. So I think that here, perhaps, in this mixed bag, we have some animals that are
very similar.
Very similar. So thank you very much, and
thank you very much.
It has been a pleasure.